The oil sell-off continuing this morning with crude hitting another multi-year low this morning, just pennies away from breaking below $40 a barrel. Analysts at Citi say a global oversupply, falling demand, a slowdown in China, and the return of oil from Iran are all putting downward pressure on prices. While some market watchers are warning to stay away from the energy sector, my next guest says it is time to start moving in. Joining us right now is Commonwealth Financial Chief Investment Officer Brad McMillan, joining Marion Bartels and Dagen this morning with me. Good to see you, Brad. Thanks so much for joining us.
Thank you for having me.
So you want to buy oil price? You want to oil crude oil, or you want to buy oil companies?
Oil companies at this point. I think crude probably still has further to drop. We've seen enormous supply expansion. It's a technology story now in the U.S. more than anything else.
Because of the shale revolution.
Exactly. And we know that, and we see production increasing even as drilling decreases. So that's a huge story for the future. But oil companies are starting to get a handle on this. And the financial distress means that there are going to be opportunities for companies with cash and capital to take over assets very cheaply.
Yeah, I think Brad makes a good point in terms of valuations. You're talking about, what, single-digit valuations on some of these oil companies. But why would lower revenue as prices go down not be a factor for the oil companies?
You're going to see enormous efficiency, and you're going to have disproportionate ability to chop out the higher cost drilling areas and focus on lower drilling areas. The damage is current. The advantage, the opportunity is in the future. As we improve the technology, as production continues to increase, as they strip out these legacy costs, you're going to have opportunities, again, for companies with capital to be able to make things happen. Exactly.
But how much more volatility do you have to deal with, though? Because what Marianne was talking about is you're going to have your clients calling you on the phone as these companies, just yesterday, the whole host of the biggest names hitting new 52-week lows.
Because if you look at the high yield portion of the market, it's still under a lot of distress in the energy sector. So we expect more volatility, and we're preparing our clients for more volatility. We don't disagree that there's value, but in my lifetime, in all the years I've been working on Wall Street, as long as crude is going down, energy stocks don't go up.
And I agree with that, and that's historically how it's been, but costs have been rising during that time period. When you move into a decreasing cost and increasing productivity environment, I would argue there are going to be increasing returns to scale. And the disruption in the high yield area, which is absolutely correct, is something that's actually going to give advantages to companies with capital. They're going to be able to go in and take advantage of that. But I certainly don't disagree. There's going to be a lot more volatility.
Yeah, what we see happening is some private equity firms now opening up and asking for funds to take advantage of what you're talking about. Do you think that you're going to see more of this? We've only seen a few funds do that. Would you use the private equity venue, or how else would you look to invest clients' monies in these opportunities?
I think right now there is a private equity opportunity in place simply because the big oil companies are dealing with the volatility, dealing with the problems. At some point, I actually don't think it's going to be too long, in the next year or two, the big companies are going to refocus on being able to do that, and they have expertise that private equity simply doesn't have.
How does this impact the Fed and year-end for equities at this point? What did we learn yesterday from the minutes?
The minutes, to me, were much more dovish on inflation than I thought, but they were much more hawkish on employment. Bottom line, I still think the Fed is going to increase rates in September because they want to get off the bottom line. But at the same time, inflation is not a problem. It's not going to be a problem. The real question here, is it good low inflation or bad low inflation? I believe it's good for the U.S.
Not if you're in the Federal Reserve, though. I mean, it seems like there's a feeling in the language, even in what's being written in the Wall Street Journal about the Fed, that there is a growing reticence to move in September. And you definitely see that in the financial market.
Well, the market is pricing that in. The market had a 50%.
Let's take a look at the 10-year. Rachel, go ahead.
The market had a 50% probability of the Fed moving. Now that's dropped to 30%. Right. The bright spot is employment, and the bright spot is actually housing. We haven't even talked about housing. I think China is one of the big issues, and what we're seeing now happen in emerging market currencies. So it's the economy and the devaluation that you're seeing. And we think China might have even been moving ahead of a potential Fed rate hike.
You said the market's pricing in that now the Fed may not raise rates because the 10-year is at 2.09%.
The 10-year yield is starting to break down technically, pointing to lower lows, and could break 2% technically. And then you're seeing utilities break out to the upside.
Yeah.
So what
Yesterday
the market,
you saw
so
that.
this is what the market is saying. The market is saying that the Fed is on hold. We as a House still have a probability that they raise in September, even with risks rising that they may have to push it out to December. We think they want liftoff, so they have tools because they don't have any tools in their toolbox. They will be extremely data dependent from now going into this September meeting.
Wow. Do you think the 10-year breaks 2%?
I think there's a real good
Getting close,
chance.
yeah.
We see oil continuing to drop. China's devaluation, very deflationary globally. Could happen.
Brad, thanks so much for joining us.
Thank you,
Appreciate
Maria.
it very much. Brad McMillan, Commonwealth Financial Chief Investment Officer.